Hello everyone, welcome to my channel Risk Modeling Hub. Today is day 14 of our 100 Days of ECL Mastery series. Today we are diving into one of the most critical foundations of effective credit risk management, portfolio segmentation for expected credit loss calculation. Specifically, we'll explore how to segment your portfolio across three essential dimensions: retail, corporate, and SME. Each segment has distinct risk characteristics, behavioral patterns, and economic sensitivities that directly impact your PD, LGD, and EAD models. But why does this matter? This is because proper segmentation ensures your ECL models are accurate, defensible, and aligned with regulatory expectations. So, if you are new to my channel, let me tell you that I create easy to understand educational content on credit risk modeling and validation, Basel, IFRS 9, machine learning, and career guidance to help both the beginners and experienced professionals build successful careers in banking and analytics. So please take a moment to subscribe to my channel and don't forget to press the bell icon so you never miss my future videos. Also, if you have any questions or suggestions, please feel free to leave them in the comments. I'll answer them. Throughout this video, we'll examine the best practices for defining these segments, understanding their unique risk drivers, and ensuring your models capture the true risk profile of each portfolio bucket. So let's get started. Let's first understand why segmentation is required in ECL modeling. So basically, the problem is that credit risk isn't uniform across all the borrowers. When you mix different type of borrowers together, you get a distorted picture of credit risk. And that's why the segmentation is essential for accurate expected credit loss modeling under IFRS 9. So without segmentation, you would have mixed risk profile. Imagine throwing all your customers into one bucket. You would have retailers, corporations, and small businesses all lumped together. This creates a misleading average that doesn't reflect the true risk of any single group. But with segmentation, we have homogeneous risk cohorts. By separating the borrowers into distinct groups, retail customers, corporate accounts, and small to medium businesses, you create homogeneous cohorts. Each group now has similar risk characteristics and failure patterns. But why this matters? Have you ever thought about it? Let's understand this through the five pillars of the segmentation. First, different borrower types have different failure channels. Second, IFRS 9 requires this homogeneous grouping by regulation. Third, the regulatory scrutiny through Basel, PRA, and EBA frameworks they demand this rigor. Fourth, the proper segmentation prevents underestimating some risk while overestimating others, which protect your capital. And finally, distinct segments allow for collaborative PDLGD models that capture each group's unique risk parameters accurately. So, the bottom line is that segmentation delivers unbiased ECL measurement. Each segment responds differently to economic factors like GDP changes, unemployment, and interest rates, making your risk models more precise and compliant. Now let's understand the product-wise segmentation framework. So banks need to partition their loan portfolios into homogeneous risk groups based on product type and borrower class. Here we will see how the three major segments break down. First segment is about retail. These are individual borrowers with income-driven risk. The portfolio includes mortgages, auto loans, personal or term loans, and revolving credit like credit cards. Risk drivers here are employment, household income, and credit behavior. Next segment is about the corporate. These are business borrowers requiring underwriting, bespoke underwriting. And you will find here term loans, working capital lines, project finance, and trade finance. Here, the revenue, sector cyclicality, leverage, and cash flow volatility they drive these risks. Third segment is about small to medium enterprises, shows a hybrid profile. Retail like processes but corporate level exposure. Products include small business loans, merchant and cash flow loans, invoice and receivables financing, and overdraft and credit lines. Each segment can be further refined by geography, sector, collateral type, tenure, exposure size, and credit rating for even more precision. Now let's talk about what are the homogeneous risk pools. These are grouping of financial assets that share similar credit risk characteristics. There is a core requirement under the both IFRS 9 and the Basel regulatory frameworks. So, for a pool to truly qualify or classify as homogeneous, these three critical elements must align perfectly. First, the loans must show similar probability of default response. They react the same way to credit deterioration. And second, they need similar loss given default response. If they default, the recovery rate is comparable. Third, they must demonstrate similar exposure at default response. The outstanding balance behaves predictably. When all the three overlap, you will have a genuine homogeneous pool. So let's consider two construction sector loans with a 10-year tenure in the same region, both secured. They share similar characteristics and respond identically to credit risk changes, so they belong in the same pool. But let's say a prime residential mortgage with a 25-year tenure and high LTV collateral is fundamentally different from a subprime auto loan with a 5-year tenure and depreciating collateral. They respond differently to the same economic shocks, so they must stay in separate pools. So, from the IFRS 9 perspective, the real question is simple. Do they respond similarly to changes in credit risk? If two loans react differently to the same macroeconomic shock, they don't belong together. They need separate pools. Now let's understand why one model doesn't fit all loans. So different loan types have distinct loss drivers that demand these segment specific models. A single approach creates systematic estimation errors across your portfolio. So first segment is the retail mortgage. The primary driver is unemployment, which creates payment stress for homeowners. Collateral is residential property with cyclical housing market values. Macroeconomically, defaults correlate heavily with unemployment rates. Recovery ranges from 50 to 70% and is predictable and stable. Defaults tend to happen gradually over a long tail distribution. Segment 2, corporate loan. Here GDP and interest rate are the main drivers. Revenue declines and rising borrowing costs squeeze business profitably. Collateral includes business assets that depreciate rapidly and have thin liquidation markets. The macro link is sensitive to GDP growth and interest rate changes. Recovery is volatile, ranging 20 to 80% depending upon the asset type. Defaults often occur suddenly during the economic shocks. Next segment is about the SME loans. Owner insolvency and rapid business failure, these are the primary risks. Collateral is typically personal guarantees, they are often unsecured. Macro sensitivity is mixed and highly heterogeneous across different business types. Recovery here is very low, only 5 to 20% because most collateral is unsecured. Defaults happen rapidly when working capital dries up. So the consequence is that using one pooled PD model across all segments produces biased estimates. A pooled LGD model causes systematic under or over provisioning. The chart shows how estimates diverge dramatically over time. Retail overestimates, corporate underestimates, and SME estimates, they are severely distorted. This creates capital insufficiency and compliance risk. Now let's understand the retail portfolio. It typically divides into four core products, each with distinct PD and LGD ranges that reflect their unique risk profiles. Now, let's understand the product breakdown. Mortgages, they are secured long-term loans with low PD of 0.5 to 1.5% and moderate LGD of 15 to 30% because residential property collateral holds value. Auto loans, they are secured with depreciation risk, showing PD of 2 to 4% and a higher LGD of 30 to 50% since vehicles lose their value quickly. Personal term loans, they are unsecured and fixed term, carrying PD of 3 to 6% and a high LGD of 60 to 80% due to lack of collateral. Credit cards are unsecured and revolving, showing the highest PD of 4 to 8% and LGD of 70 to 90% because they are typically last in the recovery waterfall. Now, beyond the product type, retail portfolios they are further sliced down by the geography to capture regional economic cycles and regulatory regimes. Credit risk groups segments the borrowers by their creditworthiness distribution: prime, near prime, subprime, and deep subprime. Tenor buckets reflect maturity, capturing how borrower behavior changes over time horizons from 1 to 3 years through 10 plus of the years. Now, if you see towards the right, you would see that the unemployment rate it is the dominant macro driver. It tracks closely with default rates across the cycle. Interest rates matter significantly for affordability. House price index affects the mortgage LGD. Regional economic conditions and consumer credit growth complete the picture. You will notice that how retail PD moves tightly with the unemployment through the economic expansions and the contractions in the graph, demonstrating the strong correlation that segment the specific models must capture. Now, quickly understand the corporate segment, which comprises businesses with the annual turnover typically exceeding the 5 millions, well above the SME threshold. And these are sophisticated borrowers requiring detailed financial analysis. So, key corporate metrics analysts must monitor: EBIT, it represents operating profit and signals true cash generation capacity before financing costs kick in. Debt to EBITDA measures leverage, how many years of earnings are needed to repay total debt, telling the structural solvency. Interest coverage calculation, EBIT divided by the interest expense. Now, different sectors concentrate defaulters differently based on the leverage levels. Manufacturing shows low default risk at low leverage but escalates to higher risk at elevated average. Banking sits consistently moderate to high across all the leverages tiers due to regulatory and cyclical sensitivity. Real estate creates the most concerning risk profile. High leverage in this sector triggers the highest default concentration, which is marked as highest. Services maintains relatively low to moderate risk across leverage bands due to asset-light business models. Now, the collateral type splits between the asset-based secured loans and the unsecured facilities. Geography distinguishes between domestic OECD markets and the emerging exposures. Now, four drivers move every corporate book: GDP growth, which compresses the earnings; interest rates, they affect the debt service capacity; sector cycle, which creates synchronized defaults; FX rates with multi-currency exposures; and debt to equity ratios signal the structural stress. Now, similarly, we need to quickly understand the SME portfolio. They occupy a unique middle ground. Basel still treats them as corporates for capital purposes, but IFRS in practice increasingly recognize them as fundamentally different. Owner and business default move together. When the owner struggles financially or personally, the business fails and vice versa. Now let's understand why SMEs are distinct. Owner insolvency often triggers the default before the business itself fails. Financial statements they are thin, incomplete, and unreliable. High information asymmetry makes the underwriting difficult. Volatility is higher because SME lacks diversification and face severe scale constraints. They are tightly correlated to local economic conditions and owner health, not the national GDP. Now, this SME portfolio it splits into five critical dimensions. First is the business style, which separates the wholesaling, manufacturing, retail, and services. Second is the credit grade, which distinguishes the financials quality, strong versus weak documentation. Third is the loan level characterizes, which corporate versus the personal guarantees, the personal asset base unsecured. Fourth is the data transparency, which identifies the SMEs with strong versus weak financial reporting. Next and finally is the facility type, which separates the invoicing, leasing, and working capital products. So, SME's specific risk drivers can be the personal credit scores and owner cash flow. They are paramount. Revenue volatility captures the seasonal business swings and economic sensitivity. Local labor market conditions and unemployment rates matter more than the national GDP. Guarantee coverage through personal assets provides the recovery cushion. The risk profile splits. We need to understand, right? SME shows high information asymmetry versus the corporates, low transparency. Unsecured recovery averages just 5 to 20% compared to corporates 30 to 50%. Primary collateral is the owner insolvency and not the business cash flow. Defaults trigger through owner's problems first. BD is higher and more volatile at a small scale. So, from Basel recognition, regulators concede the SME deserve a capital charge discount versus standard corporate treatment, acknowledging their distinct risk profile. Now, let's quickly understand what we have learned so far. The three segments recap. Retail comprises of mortgages, auto loans, credit cards, and personal loans. High volume, poor statistically. Corporate includes large, lumpy exposures requiring name by name risk assessment with low default counts. SME sits hybrid, thin financials like retail, but corporate scale risk exposure. Now, five critical principles to carry forward. First, the homogeneous pools aren't optional. IFRS 9 requires them for unbiased ECL. Second, we segment by product first, then layer depth through collateral, geography, and credit quality. Third, validate the homogeneity by testing the macro shock response. Right? If segment splits differently, the design is wrong. Fourth, remember that one model biases everything. Pooled approaches systematically underestimate the retail and SME, while overestimate the corporate. Fifth, be always prepared to defend every segmentation cut with data and economic reasoning against the regulatory challenge. So, have you ever thought about why this matters tomorrow? Where retail defaults cluster in the first 2 to 3 years, your observation window must capture the signal before it fades. Corporate defaults scatter across long horizons. Performance metrics need extended observation periods. SME default timing is bimodal. Window design must accommodate both owner insolvency triggers and business cash flow gaps. So, without segmentation, every window you calibrate afterwards gets distorted. The foundation must be right. So, you have now mastered the fundamental concepts, and tomorrow moves to the observation windows, why each segment needs different look back periods, and how to design them defensively. So, coming next will be the macroeconomic calibration strategy and forward looking probability adjustments under the observation window. We'll understand that. So, we are at day 14 of our series, and up next, we'll talk about observation window versus the performance window in credit risk. Very important concept when it comes to building the models. People often get confused in this topic, but don't worry, I have got you covered. So, if you found today's video useful and if you feel that you have learned something new, please hit the like button and subscribe to my channel Risk Modeling Hub so you don't miss any future episodes of 100 Days of ECL Mastery series. Day 1 to 13 establish the foundation, PD, LGD and AD concepts, staging logic, and data sourcing. And today marks day 14, where you are learning portfolio segmentation, the structural foundation for every model that follows. From day 15 onwards, the technical build accelerates, modeling macro variables, calibration methodology, and forward-looking adjustments. So, observation window versus performance window would be my next topic to cover from the day 15 perspective. Earlier episodes already have covered what ECL, PD, LGD, and AD actually mean, and video 8 also explained about the risk staging. I would request you to check out the playlist onto my channel, where each video description mentioned onto the slide in front of you has the video covered. Right? So you have mastered your foundations. You can revise them by checking the playlist and going starting from day 1 till day 14. Right? Also, if you have any questions or feedback, or if there is any specific topic you would like me to cover next, let me know in the comments. I read every comment and would love to hear from you. So, thank you so much for watching, and I'll see you in the next video. Thank you so much.